in Jesus' name. Amen. We want to welcome everyone to this training session. We do this because we believe that knowledge is power, and
Jesus' name.
this, this,
Amen.
the scripture tells us that people perish for lack of knowledge. Often I see that and I am puzzled. That is not lack of faith. It's not lack of wisdom or knowledge. So that we've gathered some experts to speak to us on vital things to deal with smart strategies for understanding the Canadian tax system. And indeed, I am all for it. I will ask you to avoid every distraction because there are a lot that will benefit you today. I will be hosting this jointly with Pastor Shade, who will step in and deal with some of the hosting part of today. And we are glad to have you all. I want to especially welcome Kamsi and Joshua, who will be speaking to us today. Shade will say more about them before they speak. And that's my welcome to all of you as the host of today's event. You're welcome. Pastor Shade, you can proceed now.
Welcome, everybody. Welcome to this special Smart Strategies for Understanding the Canadian Tax System. We have two speakers, like Reverend has said. We have Mr. Joshua Bacchus, who will be speaking first, who is our speaker one. Mr. Bacchus has been in the accounting and financial industry for over a decade and has accumulated a wealth of experience and knowledge that allows him to bring practical solutions to his clients. I can testify to that, even though I've been in this country for so many years. This year alone, he gave me some ideas of why my expectations were not met, which I thought I knew what I was doing. But that's one of the reasons why, we bring specialists to Godways to minister to people in their own profession. When he became an accountant, his desire was to become a well-rounded and diverse financial expert that led him to pursue a higher education and to further his knowledge in the financial industry. He did this while continuing to dedicate his time to clients in providing them with financial solutions, which accumulated to his professional experience. Mr. Bacchus is a CPA and a CGA, the Chartered Professional Accountants of Ontario, is a CFP Certified Financial Planner by the Financial Planning Standards Council. He has the CLU Chartered Life Underwriter from the Institute for Advanced Financial Education. He is a registered retirement consultant, Canadian Institute of Financial Planners. And he has a Bachelor's of Commerce, Ryerson University, and then Business Administration, Humber College. We're going to welcome Joshua Bacchus. He's our speaker one today. Welcome.
Thank you, Pastor Said, and thank you, Rev and Godways, for allowing me to share today. It is an honor and a privilege to be able to share tax planning strategies. And as Rev was saying, it's very important for us to know how to use these tax strategies in Canada. Because as we can see, in Canada, we could pay a lot of taxes, but the key is if knowing, as Rev was saying, knowing the strategies and knowing is half the battles to know how we could retain that money in our pockets based on the Income Tax Act. So I will present my screen and we will start my presentation. So as we go through tax planning strategies, we want to know there are different types of tax returns. So the one that most people are familiar with and that we all as Canadians have to file in Canada is called the T1 personal tax return. And that's the tax return we'll be focusing on today. We also have corporate return, which is the T2 return. And then we have T3 returns, which have to do with trust. So these are the different types of tax returns that are required to be filed in Canada. Now, why is tax planning important? It's important for any individual that receives any type of income, multiple or sources of income, such as employment income, interest income, dividend income, rental income, capital gains. If you're receiving EI, OAS, CPP, maybe you're receiving RSP or a RIF or a pension, or maybe you're self-employed. So we understand that why is this important? Well, when we talk about the taxes in Canada, well, we live in Ontario, but this shows us we have to pay both federal and provincial taxes. So here we see these are the provincial tax rates, and this is what we're paying in Ontario, and that combined with the federal tax rates we see right here 54%. If we are making at the top marginal tax rate is 54%, that means that the government's we're taking home less money, right, than the government's taking. So this is why tax strategy is so crucial to understand how we get taxed and why we try to see how to use the tax credits and use our deductions, because this is the highest tax rate in Canada. And then we could see even when we receive dividends and capital gains is taxed at 50%, and then dividends, we get a dividend tax credit. That's why we see a little bit of difference in those top marginal rates. So returning to our presentation, we could see why it's very important to understand how we're taxed in Canada, as we are taxed very heavily at the top rates at 54%. The first thing we want to understand is there's lots of benefits to filing your tax return. So as we are focusing on people that may have not filed a tax return yet, maybe they only are just turning 19, or they may have just came to Canada, right? You may right now, as if you're in a certain threshold of income, you would qualify for something called the Canada Groceries Benefit. So it used to be called the GST HST credit, but it was just recently converted to the Canada Groceries Benefit. So this, by filing your tax return alone and you meet the threshold, you could be eligible for this Canada Grocery Benefit. And it's just to reimburse people with this income at lower households, and the credit is based on the family's net income, right? And so if you're married, only one of you would be able to claim it. Again, but you have to also meet these additional criteria, like being 19 years old and stuff, to start receiving that benefit. Even if you're a senior and you file, again, when you put in your property taxes or how much rent you paid, you would be able to also receive the Ontario Trillium benefit. So again, these are key benefits we want to understand, that based on your threshold and income, this is some benefits that can be deposited into your account periodically by just filing your tax return. We also know that if you have children, you may also be eligible for the Canada Child Benefit. So this again is all based on how much family income you have. And by filing your tax return, you would be eligible to start receiving the Canada Child Benefit for children that are 17, up to age 17, right? You will get that child tax benefit. And even if, but again, it's all determined based on just filing your tax return would make you eligible for these benefits. why also it's important to file your tax return. Again, when we're talking about if you are new to Canada and you've immigrated to Canada um, as a Canada resident. So now if I live in Canada for more than so if there's 365 days a year, and if you lived in Canada more than 50% of the time, then you're considered a resident of Canada. And if you're considered a resident of Canada, then you're required to file your income, whatever that income is worldwide. So we have whatever, even if you are, you're in Canada and you have income outside of Canada, you're still required to give that information on your tax return because we are taxed as a Canada resident on our worldwide income, not just the income in Canada. So another important thing is filing your tax return if you have foreign property over 100,000 in cost. You would have to give additional information to file this form. And again, these things are important to file because if you don't file or give this information to CRA and you're a resident in Canada, you could get penalized. So it's important to be aware because again, we're already saying we already have to pay money on a certain marginal tax rate, but understanding that we could even be penalized for not disclosing certain information, and we don't want to give CRA more than we already have to. Other important thing to understand as well is the principal residence exemption. If you own your own home and you sold it, you also are required now to declare that home in Schedule 3 of your tax return. So again, you know, disclosing this information to CRA, even though we don't pay tax on it because it's exempt from taxes on our owning our own home and we sell it as long as it's our principal residence, but we have to still disclose it to the CRA. Now, the most important things in understanding in tax planning is what is a deduction versus what are tax credits. So again, we already saw the different types of income we might be receiving. We would normally receive that income by getting our T4s if we're an employee. If we're subcontracted, we might get a T4A if we're self-employed. If we are receiving investment income, we could receive T3s, T5s from interest from the bank. So these are all different incomes that we would have to declare on our tax return. But understanding now that we could pay based on our marginal tax rate, we are going to pay a certain amount of tax on that income. So the first thing we want to understand is how to reduce that income through a deduction, which will reduce that taxable income. So that reduces the income and it's used to calculate our taxable income. And then the next thing we're going to discuss is a tax credit because this is like a coupon. Just like when we go buy groceries and we like to use a coupon to get a little bit of a discount, well, that's what a tax credit is. We want to know the tax credits available to us so that we are able to use that coupon that would help offset that taxes payable. So typically, when you look at your T1 return, you would have seen different deductions on your tax return. So again, you would have calculated your total income based on the different tax slips you received and the income you have received from various sources. And then you want to be able to deduct that income. And then we might have a pension at work, so that gives us a deduction. Our brother is going to talk a little bit more about how RSPs are very important to use as a deduction. Again, deduction meaning it's going to reduce that taxable income. So RSPs can be a very key to helping being that deduction, which our brother will share later on. You may also be paying into a union, or you may be like a membership, such as Ontario Teachers Colleges or nurses. They also pay for their annual membership. So you want to make sure that's being deducted, right? We're going to talk a little bit more about childcare expenses as a deduction, as well as other deductions are coming up on my slides soon. But I think the key is to take away is understanding the deductions that are available to you, right? Even employment expenses. So again, if you've been working from home, you might have received a T2200 from your employer because either you're using your vehicle for work or you are working from home more than 50% of the time. And again, that allows you to make a eligible deduction under employment expenses. So understanding the deductions are key. So to use your RSP deduction, you would want to know what your unused RSP deduction room is at the end of the previous year. That's by looking at your notice of assessment, you would see how much RSP room you would already have existing available. Then if you're already receiving a pension, that goes into the calculation to reduce your RSP room because again, the government doesn't let us double dip. So even though we have we want to use RSP, but we already have a pension, that pension reduces the RSP room that we already are receiving. And then to calculate your RSP room, you're using 18% of your previous year's earned income. And then that will be able to dictate how much RSP room you're able to deduct from your tax return. Another deduction is move-in expenses. So if you were required to move to carry on a business or to be employed in Canada or to become a student and you meet certain requirements, such as 40 kilometers closer to the new place of business, and the old residents and new residents must be located in Canada. So meeting all these criteria, you might be eligible for moving expenses. Childcare expenses, I said, is another major thing. So if you have children that are being taken care of because you're working, so you got to put them in daycare, or they're in an after-school program, right? These are eligible childcare deductions. So these are things that you want to be aware of are that you're filing because again, it reduces that income that's going to be taxed. And these are all eligible deductions and you want to make sure you're making the most use of them. So again, if you have you and your spouse, what happened is the deduction goes against the spouse with the lower income. Again, giving you back lesser taxes on that you would have to pay on your income. Another major deduction is when you get older and you are receiving a pension or you start receiving your RSP or RIF, you also may be able to split half of that pension with your spouse. So now, even though your spouse might be getting a significant pension and you didn't, right? Now the Income Tax Act allows you guys to split that income. So again, keeping you in a lower marginal tax rate for both of you, right? So another thing you want to understand on the strategy of income splitting. This leads us into now about our tax credit. So while that's deductions, we could also understand that there, as I mentioned, that reduces the income that's getting taxed. So if, for example, right, we go back to that, let's just go back to this for example. Let's, for example, say I had total income of 60,000, right? That means if I didn't have any deductions, I'm getting taxed within the tax rate at 60% of 60,000, sorry, in that marginal tax rate. But if I had a RSP contribution for that year and I put that $10,000 in RSPs, that's a deduction. So now I'm only getting taxed on 50,000. So again, that's how a deduction works, right? If I made 60,000 for the year and I have something that's an eligible deduction like an RSP, I put in 10,000, I have now reduced my income that's being taxed at 50,000 to 50,000. So again, if you're an employee and you're looking at your paycheck, you're seeing that paycheck, you're getting taxed every time you get paid. So assume that if you put 10,000 in RSPs, now whatever tax was taxed on that 10,000, you technically would get it back. That's the strategy here in using an RSP or any kind of deduction. So now when we talk about tax credits, these are amounts that, again, I mentioned is like a coupon to help offset the taxes that are payable that have been calculated on your marginal tax rates. And so these amounts change every year based on how everything always goes up and inflation and all of that. So all of these amounts are actually adjusted every year. And some of the main tax credits is that in Canada, we all get this basic personal amount. So right now that amount is about 16,000. So if you made 16,000 in income, you wouldn't have to pay any taxes, right? Because this basic personal amount, which is a credit, already covers that amount. Again, across Canada for all of Canadian residents, we get that basic personal amount. So that's our first credit to understand. When you look at your T1 return, everyone will see that basic personal amount. If when you get older, you might be also able to get the age amount. So again, that's based on certain criteria of income, but again, to help people when they're older to reduce the taxes they pay. Spousal amount, so maybe only one spouse is working, the other's at home taking care of kids, whatnot. So that now, when I mentioned that you have this basic personal amount of 16,000, you now also can use your spouses, because if they weren't working or if they worked very little, then they didn't use that full basic personal amount, that credit gets transferred over to you. So that's again almost $30,000 where you wouldn't pay any taxes yet because you would have been eligible for those credits. Another one is the first time home buyers tax credit. So again, our brother might mention about how you can strategically use the RSP or the first time home savings account, because again, that's a deduction on your taxes. But then when you're setting up and planning to buy your first home, you would be eligible for this first time home buyers tax credit. Again, government giving you a little bit of break the first year to buy when you're buying your home, to put that money back in your pocket to help you out in that first year. If you are single and you have a child, you may be eligible for that eligible dependent amount. So again, just like the basic personal amount, but if you have a child now, the government gives you this eligible dependent amount, which again gives you almost $30,000 in credits already that would help you not have to pay any taxes. So again, this is helping out singles, single parents. This is a way the government tries to make sure they're putting back taxes in their pockets or keeping more income, because to help them out with based on their situation. You may also have adoption expenses, so you could claim this as a credit. As when we're working in Canada, we all get the Canada employment amount as well. So these are different types of tax credits, as well as when we start receiving our pension, you get the pension income credit. So again, depending on the different stages of life or the different type of income you're in, you may be receiving these different types of credits. Another major credit you want to understand about is the Canada Caregiver Tax Credit. So if you have a dependent that has a physical or mental infirmity, you could get a caregiver amount. This amount has changed. Like I said, it changes, it does adjust. So please excuse the amount because it would probably be different this year. But if you have an infirm dependent spouse or common law partner, or an infirm dependent or an infirm child who is under 18 years, you would be eligible to receive this caregiver amount. So again, somebody in your family that is dependent on you for day-to-day living activities, this is something you may be able to qualify for. If you have infirm dependents who are parents, grandparents, so basically any or adult children, so anybody over 18, you also could get this caregiver amount. So if you are taking care of your parents who, again, need your assistance on a day-to-day basis because they're sick or they're not able to take care of themselves, you want to make sure that you're eligible to claim this caregiver tax amount. And that, again, is just a government understanding based on your situation. You got to spend money to take care of them. They're trying to give you back this to make sure you could save that income on your end through this tax credit. And if you have somebody that has a disability, right, you would want to apply for the disability tax credit. So there's a Canada caregiver tax credit for, again, if there is somebody that is physical or mental infirmity, but that doesn't necessarily mean they could qualify for the disability tax credit. But you would still need to be able to prove to CRA how that person is dependent on you and want to have a letter on the doctor on file to state that. But if you are eligible for the disability tax credit, or your child has a disability, or your wife has a disability, or your spouse, you would automatically qualify for the Canada Caregiver Tax Credit. So if somebody other than you can qualify for the disability tax credit, that Canada Caregiver amount is actually automatic as well. But you would, if there was somebody with a disability, you would want to fill out the form T2201, and you're going to get it signed by your doctor. And again, this gives you back an amount as a tax credit where again, the government understands people with disability requires more expenses, more time, more service. And this is a way they try to make sure we could keep that income in our pockets by offering us this disability tax credit. If you are a student, you would have to pay tuition, and you would have gotten a tuition receipt from the school, a T2202, right? And this are credits, federal tax credits that you receive, again, which is like a coupon that you would use to help reduce the taxes payable in a certain year. So if you have children that are going to university or to college, then you would want to make sure that you are able to transfer up to 5,000 to the parent's tax return. So most children may not be making, enough. Like we said, you're already getting that $16,000 in basic personal amount. And if that child is working, they may not go over that amount in their part-time job. So what happens is you would be able to transfer that tuition credit, whatever you were paid in the year, could be transferred to the parent from that T2202. But again, if it isn't used, it actually gets carried forward. And that gets carried forward into future years. When you do start working, you'll be able to claim those credits, which will help you to reduce the taxes payable, and you'll get a good refund in the year you are working and you get some good money. Then these tuition credits will apply. So again, you want to make sure those are being captured, and even if they're not being used, make sure they get carried forward to a future year where you could use it. Medical expenses, again, is another way of getting a tax credit. So if you do have medical expenses, you want to make sure those are included on the tax return, as those give us a calculation based on 3% of your income, of your total income. You would get a certain amount of credit that would be applied if you do have medical expense. So again, going back to somebody that may be in your family that has medical issues, here you could see is how the government helps us by using that Canada Caregiver Tax Credit and putting in these medical expenses, help us to give us back those monies or keep those monies in our pockets. And this is the way the government kind of sets up the system so that it can be beneficial to us. But this can only work if you file your tax return, and understanding you're not missing these pieces of the puzzle so you can keep that money in your pocket. And another major one that we want to know about is charitable donations. So this one, very strategic in getting you back and reducing that taxes payable or even getting you a refund. So again, this is a very easy tax credit to receive. All you have to do is donate. All you have to do is pay your tithes, right? And boom, we get this tax credit on our taxes, and that really helps us reduce our taxes payable. So that's the key tax credit, key way of getting our coupon. And then of course, we know we're not only is it benefiting us, but we know that it is also going to a good cause. So that ends my part of the presentation. Thank you.
Wow, thank you very much for that informative session. I've learned a lot. I know there'll be questions coming, but before we get to question, I will want the next presenter to speak so we can take the questions together. I have questions myself on the tax because this tax thing is a bit of headache. I don't know about you, but I know nobody wants to give money to this to CRO unless they must. So we need to know a lot more how not to give money we don't have to give, and then give what we must give. That's the idea. So I'm going to call on the co-host, Pastor Shade, to also introduce the next speaker.
Thank you, Rev. Thank you. 1 second. Thank you, Rev. We'll spotlight you back, Kamsi. I'm going to introduce our next speaker, Kamsi Okoye. As a licensed advisor, his goal is to help protect every one of us, protect our present, and also secure our future while keeping our financial needs and desires at the forefront of his mind. Kamsi has dedicated his career to helping families, professionals, and businesses make better financial decisions that actually put every one of us in an advantageous position. His desire is to make a positive impact in the lives of families, professionals, and businesses through education, sound advice, and guiding them in implementing effective strategies to achieve their financial goals with confidence and promote a stress-free and lucrative financial future. Many times I wish, so many of these things I knew then. Probably will be a millionaire or billionaire now. Anyways, Kamsi, over to you.
Thank you, Pastor Shade and Rev, for allowing me to speak today and allowing me to be here with all of you and discuss taxes and finances. I'm excited. So I'll be talking about 3 different topics today. But first, I want to discuss how we can maximize our tax returns and reduce our taxable income. So how many of you actually want to see less money on your tax bill? I know I do. But the thing is, oftentimes we make 50,000, we make 80,000, 100,000, 150, some even 200,000 plus. And it feels like we barely keep, or we're barely kept anything for ourselves. So how can we maximize our tax returns and reduce our taxable income? So let's look at it through the lens of a story. So Stacy is a professor that works at a university. She works at a university in Ontario, let's say University of Toronto. She makes $80,000 a year before tax. And every time when tax time comes around, she sees a tax bill around $20,000 and she's not happy. She takes home $60,000 and wants to find a way where she can reduce that tax bill. So what can Stacy do to reduce that tax bill and reduce her taxable income? So one thing she can do is she can contribute to her RRSP. So your RRSP is a registered retirement savings plan. So everyone who's an employee or self-employed person in Canada that's working can contribute up to 18% of their income to a maximum of around $32,000 in 2025, and I believe it's going up to around 33,000 2026. So what Stacey can do, let's say she decides to contribute around $10,000 into her RSP. This will reduce her taxable income to $70,000. And since Stacey is an employee, if her taxable income has been reduced to $70,000, it means that she has overpaid on her taxes, meaning that she would be eligible for a tax refund. So since her taxable income has been reduced by around $10,000, she'll be eligible for a tax refund of about $3,000 to offset her taxes. She could also contribute to her first home savings account. So similar with your RSP, your first home savings account is also allows you to deduct the contributions you make into that account from your income. So let's say Stacey contributes $8,000 into her first home savings account. This will allow her to drop her taxable income by $8,000. So let's say she contributed $10,000 through her RSP and $8,000 through her first home savings account. Her taxable income will be reduced by $18,000, meaning she'll only be able to be taxed on $62,000. This will help her save on her taxes and also reduce her taxable income. Stacey can also look into utilizing some tax credits. As Josh just spoke about, he covers some of the tax credits that we can use to reduce our taxes and save on our taxes. So one thing she can do is utilize the charitable donations tax credit. And let's say Stacey was to donate $1,000 to charity, she would save about $360 on her taxes through that $1,000 donation. She could then also look into deducting any employee expenses she has. So this includes travel, this includes office expenses, equipment, this includes employee expenses that you have through working, through parking, for example. You can deduct this from your taxes to reduce your taxable income. But then Stacey has a husband. Her husband's name is Chris. Chris is a self-employed engineer. He lives in Ontario and works in Ontario. He makes about $150,000 a year, and he is self-employed. And every year, he receives a tax bill of about $48,000, and he's not happy. He wants to figure out a way to reduce that tax bill. So what can Chris do to save on his taxes and reduce his taxable income? So as a self-employed individual, Chris can decide to deduct his business expenses. So this includes equipment, travel expenses, business meeting expenses, office expenses, things like that. He can add them all together and deduct them from his taxes to reduce his taxable income. Another thing which is cool that Chris can do is incorporate his business. So if Chris decided to incorporate his business, it will be his business earning $150,000 a year. And as a corporation, that would fall under the small corporation tax. So he would only be taxed about 12.2% on that $150,000 he makes through the corporation. He can then decide to pay himself a less salary because ideally he's not living off his full $150,000 salary. He only needs a partial amount of that to live. So he could decide to pay himself a lesser salary and leave the rest of the money in the corporation or even invest it into the market so that it can build returns for the future. He could also utilize his RSP and his first home savings account, similar to Stacey. If he contributes to those, he'll be able to deduct that contribution from his income, therefore reducing his taxable income. And then he could also invest through his corporation. The good thing about investing through his corporation is that it's cheaper because the money in the corporation was taxed at a less tax rate. Investing is cheaper. And also, since the money is in the corporation, you would have a lot more money to work with to invest into the market. So self-employed individuals can really utilize incorporating their business to save on their taxes. He could also utilize tax credits, as Joshua mentioned, and he could also go into income splitting. So this is basically splitting the returns from your business to maybe a family member who has a lower tax bracket so that you can save on taxes. And that's when we go into trusts. That's when we go deep into, you know, loans, corporation stuff. So that's something that's very complex and is different for each case. So we have to go deep into that for a specific individual. So then this is where we get into wealth building. How can Stacy and Chris build wealth through the knowledge that they now have? So now that they have knowledge on how they can save taxes on their taxes, they now want to use the tax returns that they've received and the tax savings that they've earned to now invest in different vehicles to save for the future. So the best savings accounts to build wealth in Canada are usually your RSP and your TFSA. Your first-home savings accounts are also there, but they're only there for people who are not homeowners. And also your RESP can be used to save for your child's education. But those are goal-centered investment or savings accounts for Canadians. The RSP and the TFSA are more allocated, or they're allocated for you to build wealth more efficiently. So in your RSP and your TFSA, you can invest in many different vehicles. So you can invest in, you put cash in the accounts, you could also put your stocks, you could put your funds, invest money into funds, you could put money into metals, and you could put money into options. So there are many different vehicles you could put the money into. The RSP and the TFSA are just the accounts where you could put the money into many different things. For example, if you're someone that likes to invest in ETFs, mutual funds, segregated funds, you could put your money into a fund, and over time, your money can grow and give you interest and give you returns on your investment. If you're into stocks, you could put your money into the Magnificent Seven. So the Magnificent Seven is Tesla, Meta, Apple, Alphabet, Amazon, and Nvidia. So that's the Magnificent Seven. And last year, Alphabet did about 68% plus return last year, up to 89% return. So there's some people that made 89% return on their investment last year through investing in Alphabet. And even Amazon did about 5%. I believe it was Meta that did around 39%. So these stocks are usually very reliable. These are the stocks that dominate the stock market and keep the stock market running. So they're very reliable. You could put your money into them and get consistent returns. So that's the Magnificent Seven. There are many funds you can put your money into. I know US equities is a popular one. Last year, US equities did about 9%. There's some funds that did pretty well. For example, the Canadian IA segregated fund did about 21% last year in returns. There's also some that did 20%, and there's others that did 25%. So there are many different funds and stocks you could put your money into to build wealth and gain consistent returns on your investment. It wouldn't be smart to just put your money into the accounts without gaining a return on your investment. You could also put your money into metals. As of now, gold is rising due to the conflicts in the world, the Iran and US war, and how inflation is causing the cost of oil and even foods and other goods to rise. Metals are rising in price. So those who have invested in metals, in gold, silver, things like that over the years are seeing a return. And metals are usually seen as a security. In the case the market crashes, you want to have some money in metals to have some protection there. And then you could also get into options. So options is very hands-on. It's more like trading. So options is basically you're buying a coupon to buy or sell a stock at a specific price at a specific time. So there are two types of options. There's a call option, which is you're predicting that if you buy this stock, it's going to go up in price. And then there's a put option, which you're predicting that if you buy the stock, it's going to go down in price. So this is very hands-on. This is for more advanced traders, that people who want to really start trading. And you can use options to an extent in your TFSA and RSP. So these are different things that we can use to build wealth in our TFSA and RSP. For most people who just want to do things and not really be hands-on, I recommend funds and stocks, as all you have to do is put your money into them and it just returned in it just gives you returns over years and years. So as you leave them in the TFSA and RSP, you should get consistent returns. But of course, building wealth is great, but we want to make sure that the money that we have in there can build consistently and we can get consistent return over the years. Because what often happens is that you put money into these accounts, into RSP or TFSA, and then we have an emergency, something happens, and then we have to start withdrawing the money. But the goal is to keep the money in the account so that over the years it can grow and we can see consistent returns on our investment. So we want to make sure that our financial foundation is set up and in place. This means having protection in place, making sure you have insurance coverage for the case of death, disability, critical illness. Also making sure your income is stable, multiple streams of income. This can help stabilize your situation, having an emergency fund, having a debt repayment plan, and also having a will and protection mandate. This will help you have a stable financial foundation so that if anything does happen where you have a financial emergency or you suddenly need money, you have this in place to protect you from having to withdraw from where you're building wealth so that this can continue to grow and this can take care of any emergencies you can have. And a common misconception that many people have is that you need a lot of money to start building your financial foundation. That's not true. For example, if you're 30 years old, you can get a life insurance policy for as little as $20 a month. If you're 25 years old, it could be less. If you're 40 years old, you're looking at about $30. You're looking at $40 to get a life insurance policy. You can also get disability and critical illness coverage for cheap as well. The idea is to get started on building your financial foundation. And as you earn more money, you can invest more into here and make sure you're more protected as you earn more money. And also, if you would like to build an emergency fund, you could also do this in a TFSA as well. So the good thing about TFSA is that you can invest in multiple different things. You can have multiple TFSA accounts. So let's say you want to dedicate one to your emergency fund, you can have one. And let's say you want to dedicate one to your building wealth, you can also do that. So that's what most people do to take advantage of the benefits that the TFSA does, because it's tax advantage, meaning that any withdrawal you take from the TFSA is tax-free, and any return on your investment is also tax-free. So it's a great way to build your emergency fund and also build your wealth as well. And also for debt repayment plan, you could also use a similar strategy. So the idea behind saving on taxes and building wealth and also having a stable financial foundation is utilizing these strategies to help you gain more money, gain more returns on your taxes, and also reduce your taxable income, and then utilizing your RSP and your TFSA to build wealth, to gain consistent returns through funds, through stocks, through metals, options, or cash, and also using that to and making sure your financial foundation is in place to protect all that you're building up here. So that's the general idea behind building wealth, and following these strategies will help you be protected and consistently build wealth over the years. So I'd like to thank you all for listening, and I'm open to any questions anyone has. Thank you.
Thank you very much for that presentation. It's very informative. We will now get to the question time. So if you have question, you can type it in the chat, and you can unmute yourself to speak if you want to ask question. I know some people may have their question already. If you want, you can unmute yourself. You can say who you want to answer the question. If you don't say who to answer the question, we decide who to answer it for you. That's okay. I'm sure Joshua Kamsi can deal with the questions. Once we hear the questions, we know who has the expertise to answer them. So I will go first. Shade will have an eye on the questions you type and call us to that. Okay, I think we are getting question already typed in, but let me ask something about what Joshua said about drug expenses being deducted. Does that include buying medication or money paid to the doctor?
Both.
Both.
And both medical expenses include anything that's not covered by OHIP that you have to pay the doctor,
Mhm.
and same with medical expenses like prescription drugs and stuff like that.
Does that also include medical insurance?
Yes. If you're paying your own private insurance,
Yes.
you would include that premium, as well as on when we're working and our employer's paying it, you might see it on box 85 on your T4 and it gets included as a medical expense.
Right. But if you purchase it on your own, you have to
You get to
deduct.
claim it. Yeah.
Okay. My last question to you is, you spoke about moving costs. Can that be deferred? Like you moved 3 years ago, but you didn't claim it. Can you claim it now?
No, you would have to go back to that year that it happened and do an adjustment to that tax return. So in the year that it happened, you can go back and always make and anything too. If you miss something here you learned today, you're able to go back and make an adjustment to that year's tax return, if it makes sense to.
Yes. Thank you. I will let Shade read out some questions we have on the chat.
Okay, thank you. So the first question on the chart is for Joshua. That what are the benefits of couples filing together?
Yes. The the benefit of filing together is a couple of things we had mentioned today was uh the sharing of the tax credits, right? So if again you didn't use all of certain tax credits, like I said, so if you had more income than your spouse and your spouse didn't work, number one is you would be able to claim that basic personal amount that they didn't claim. So there's transfer of credits that are available when you file together, as well as um like we talked about charitable donations. So again, let's say that your charitable donations, that if you applied it to one spouse, it might give you a larger refund than both of you claiming your own, right? So that way, you're able to share certain credits like charitable donations, because if everybody's gonna get the same refund, it's going all going in the same bank account, then you would want to maximize that refund you get. And that may be able to say, hey, um, let's apply that charitable donations to the spouse that gets the larger refund. So again, these are tax planning strategies when you're working with individual with with your spouse and filing together. Again, how do we maximize even pension splitting or other types of income splitting to be beneficial to you? As well as, I think the most important thing is that the CRA does use the family income to determine what benefits you might be eligible for. So again, that's why you want to file together, because if you weren't filing together, it would be hard to calculate those benefits, or it might not be calculated properly for CRA's purposes.
Thank you. Thank you. I hope that answers the question of, I hope the person is satisfied. Sorry, I didn't see the name. The next question is for Kamsi. Could you expand more on TFSA for investment and for emergency funds?
Okay, so for the TFSA, you get a 7,000 contribution from every year. And the good thing about the TFSA is that every year, if you don't contribute to your TFSA, your contribution room carries over. So you can accumulate a contribution room in your TFSA. So TFSA is opened in 2009. So for those who are Canadian residents or lived in Canada, they have the full amount of contribution rooms since 2009 or 2008, one of the other. So for contributing to your TFSA, you could open multiple ones in different places. For example, you could open one in Wealthsimple. You could then open one with a financial institution. And then you could set up one account as an emergency fund, and you could set up one as an investment fund where you're trying to build wealth. So in the emergency fund, you can invest in maybe moderate to low risk funds, such as a income fund, or even some bonds, things like that. You can invest in that in an emergency fund. And then if you want to build wealth, you can look more into more high risk or medium risk. That could be looking at US equity fund, you could be looking at Asia fund, even international equities, where it's a mixture of many different countries, especially in Europe. You can look into funds like that to build consistent returns on your investment and also have a diversification within your investment funds. So ideally in your emergency fund, you want something that's more stable so that in the case of an emergency, you know you have the money there and the market isn't, if the market crashes, your money wouldn't really take a hit. So you want to make sure the money's in something stable. And then for your TFSA, RSP, you want more higher returns, you're going to have to take on more risk. So you're going to have to look into more medium risk, maybe even high risk, but medium risk ideally is where you want to be. That's the sweet spot. So US equities, Canadian equities, those are usually very medium risk and not too high risk. So
can I ask a follow-up question to Kamsi before you read the next question? So are you saying that when you invest in a RRSP, you decide where the money should go to, like which fund is going to be invested in or what the money should be used for? Is that how it works?
So usually when you invest, you're meant to decide where the money's going to go into. For example, with a financial institution, for example, IA, you could decide when you speak with the advisor sits down with you and you decide which funds you want to put your money into. So even if you do it on your own with like Wealthsimple, for example, you're going to choose which stock, which ETF you're going to put your money into. So that's how it works. It's not just you put money in your RSP or TFSA and it figures it out for you by itself. You have to specifically choose which fund, which stock you want to put your money into. And then you get returns from the performance of that stock or from that fund. So
it's a win-win then, so that if you go through RRSP, instead of going straight to put your money in the stock, you'll be winning because you're getting tax deduction because you put the money in RRSP, and yet you're investing in stock and making money through the same fund.
yeah, and I just want to add this thing for RSPs. The idea behind the RSP is that you're deferring your taxes. So when you withdraw money from your RSP eventually, when you're retiring, you're gonna have to pay money on that tax on that withdrawal. And the idea behind is that when you retire, ideally you should be at a lower tax bracket. So when you withdraw that money, you should pay less taxes on it. So you're kind of pushing your taxes to later. And when you eventually pay those taxes, it should be less than what you will pay now. So that's the idea behind investing or putting your money into an RSP. Defer your tax to later, and then later on you pay less tax on that withdrawal.
Okay, just last follow up, so that when you taking the money out, will you also pay tax on the appreciation from the stock, the money you've made because of the investment?
Yes.
Yeah. Okay. But now, because you're getting it at retirement level, you're paying less tax bracket. That makes sense to me.
Yeah, exactly.
Okay. So, Pastor Shade, you can get on with the next question. Thank you.
Thank you. Thank you, Rev. Thank you, Kamsi. Okay, so for Joshua, can you please display the tax sheet that shows what taxes and talk about that tax bracket, the those high tax brackets again briefly?
So we could see here, based on how much income you make, these are our marginal tax rates. So if when you're in between these within these incomes, we already looked at if you're in the highest tax bracket, this is the top marginal tax rate. But based on your whatever marginal tax rate that you're in, so again, what marginal tax rate means that on the first $19,000, we pay 14% of taxes. and on the next one up to 25,000 we're paying 24.10%, right? It's showing you how much excess you're paying based on that marginal tax rate, based on the higher income that you get, if that makes sense.
Yeah.
Yeah. So the higher your income goes, it's showing you the additional tax you're paying because of the additional
That's right.
income.
That's right.
So somebody can say, don't pay me anymore because it's meaningless.
Totally, exactly. You work so hard just for the government to take, but that's why to understand really how to use like a RSP, because for example, let's pretend you made 110,000, right? So now you're pushed up to the next marginal tax rate. But simply by contributing 10,000, you put yourself back into that lower marginal tax rate, so you're getting taxed lower. And any monies that was taxed at that lower rate, you'll get a larger refund. So again, understanding where you are on the threshold can be very beneficial. If you get a deduction or RSP, you would say, hey, let me use that to reduce my marginal tax rate.
Right. That makes sense. That's very informative.
And then same to the same point we were talking what Kamsi was mentioning before, when you're ready to start collecting. So here we are, I'm working my whole life and I'm, let's say, at this 40% marginal tax rate, right? But then when I've contributed to my RSP or my pension, I'm in a lower tax rate. So this is what Kempsey was referring to, why you would, when you're using an RSP, you don't want to pull it. You don't want to use it. That's what he was saying. The TFSA is the most important for emergencies, because the RSP, you want it to use it and keep it for over the long term. Because if you did pull it and you were in this marginal tax rate, this is the monies that you would have to pay on pulling that income. But the idea, the way the RSP is set up, is that you would, it would reduce your marginal income or your taxable income. And then when you're ready to go retire and take that income, you'll be in that lower marginal tax rate.
Right. Okay.
Yeah, and to add to what Joshua said, it's important if you're a high earner, it's important to spend some of your money or allocate it to an account so that you save on taxes. Because if you just earn money and keep it, the government's going to take it anyway. So it's good to use it for your business, and then you could deduct it as a business expense or put it through an RSP. If you've never owned a home, use a first home savings account, and that will save you on some taxes because you're able to deduct that from your taxes as it reduces your taxable income. So
before we go to the next question, just while we're on RSP, but if you then, and I get the point that if you put this money away under that vehicle, at the time you're having high interest rate, you don't have to take it out then, because it means you're going to pay high interest rate. So if you then take it to pay down payment for a house, do you also pay tax on that? Or what would that be? What would be the position? Because technically it's the same as taking the money out.
is it taking it out over RSP?
Yes, to pay your down payment for purchase of the house. Would you be taxed on it?
Are you asking as
First
a
time buyer. Yeah, as a first time buyer.
so as a first time buyer, you have a limit of if you have money in your RSP as a first time home buyer, you can withdraw up to $60,000. But that $60,000 has to be in your RSP for 90 days. And after 90 days, you can use it towards a down payment to buy a property. So that's another benefit of the RSP for first time home buyers. It's called the home buyers plan. So if you are a first time home buyer, you can utilize both your RSP and your first home savings account to buy a house. You can even utilize your TFSA as well. So even combining all three is a great way for a first-time home buyer to maximize their down payment for their first property. So
So the RSP, you can use it as the home buyer's plan, as Kamsi's saying. So that's your strategy. So you're not. So again, the government's allowing you to contribute this amount to the RSP. So when you go take it for the down payment of the home, you you wouldn't be penalized. You wouldn't be taxed on taking it as long as it's through the home buyer's plan, as you mentioned, up to 60,000. But you have to repay that amount over 15 years. So that's the key in understanding. You can take this home buyer's plan out and then you got to pay it back over 15 years. The FHSA, that doesn't apply to that. That is just a freebie where you can use it to save for the down payment, no tax penalization or anything when you go take that money for the down payment. But the home buyer's plan RSP, the idea is you would take it, you would pay it back over 15 years because now you're trying to put money back into your RSP, the same money you used. And if you didn't put it back, then that amount that you were supposed to pay back in the year gets included as income in the year, in that specific year of your tax return.
Yeah. So it's essentially like a loan from your RSP. Yeah.
Right. Excellent. So do you have another question on or typed in?
Yes. Okay, this is for, I think this is for Kamsi. Would it be wise to invest in all the magnificent 7 companies? Is there such a thing as over-investment?
So if you want to invest in all the Magnificent 7 companies, your best bet would to be investing in a fund that just holds all of them, because investing in it individually wouldn't be the best idea. It just makes sense to get one fund that holds all of them, and then you get returns from that. And then overinvestment, is there such thing as overinvestment? It depends on what your financial situation looks like. If you are someone, you maybe have a stable income and you'll put some money into your TFSA RSP for the future, and then you're trying to put more in, but you still have other expenses and things to take care of. It wouldn't be wise to continue investing while you still need that money to take care of living expenses. So over-investing, it really depends on how you look at it. I think, well, from what I've seen, there's some people who overinvest, and then their money is very tied up in multiple different funds and assets, and it could be very difficult sometimes to get that money out, especially if it's something that's more rigid and not liquid. And then there's some that they have their money in specific things and they're comfortable investing in that thing consistently, such as like stocks and funds, and they incur consistent returns on that investment. So usually I advise people to choose something that they're comfortable with, that they trust and they're comfortable investing in, that if they were to lose their money in that place, that they won't be losing, their hair, and then do it consistently as well. But over investing in multiple different things can be very complex, and it is also can be a headache for you because you have to monitor different places that you put your money in. So I'll say invest in just something similar, one couple things that are similar, and then build returns from there, rather than just spreading your money out so thin that you have just so many things that your money's in. So yeah, that's what I'll say.
Okay, thank you, Kamsi. Hope if there are follow-up questions, please type in the chat. There's a question for Joshua. I'm not sure that the question is complete or not. How does one get the T220 ? Do you have to apply to receive it from your employer?
That's right. That's they're talking about the T2200. It's called the Declarations for Employment, Conditions for Employment. So yes, your employer would have to issue this, right? And it would have all the information. They would put your date you're working for the year, and then they have a bunch of questions that the employer has to answer, such as did the employer require you to work from home, to pay, use your cell phone, maybe for expenses for reimbursing for work, as I'm saying, if you work from home more than 50% of the time, or if you used your vehicle for work. So again, that would be signed off by HR or an accountant at your if you're an employee, and then you would want to make sure that's kept on file, because if CRA ask, because again, you're claiming a deduction for employment expenses, they may ask to see this form.
Okay, well, while you were on that, just an additional question to Joshua. Is there a way student loan can be tax deductible? Can it be tax deductible?
A loan for investments can be taxed. In the interest for a loan, like if you took out a loan to invest, that interest is tax deductible.
But if it's to pay for school fees, like a second degree or something,
The only interest available to deduct is the one from like this, the one you get from the government. So if you'll get a receipt every year of your student loan interest, and you're able to claim that. But again, it has to meet certain requirements from a student loan point of view to be able to deduct that interest.
right? But if it's taken from the financial house, like a loan from the bank to go to school,
Sometimes that interest is not deductible from that,
right?
because sometimes people do take it, like medical doctors or something need to take it, but
Yeah.
that interest isn't always deductible because it doesn't meet the certain requirements.
Okay. Thank you. Shade, do we have another
I
question?
have one more question for Joshua. Please, if you have questions, type it in the chat. We still have a few more minutes. So how does one get, no, that's not that one. What is the estimate that a parent gets back if $5,000 is transferred from child 2202 to the parent? Because it's the parent that actually paid the fees anyway, most of the time.
So again, great question. And again, when we're talking about these tax credits, as I was mentioning earlier, when you do get these tax credits that may be applicable to you, and then again, it would be, let's say, a tuition amount transfer from a child or a grandchild, right? All of your tax credits get added up and they get times by 14.5%. That's what gives you what would offset the taxes payable. So to answer that question specifically, 5,000 times 0.145 is $725. You could think that, again, you would get back, or it would reduce the taxes payable. So about 725. But again, what you're looking at is any tax credit that you're able to receive is normally times by this 14.5%. That's what gives you how much taxes is being reduced by. So 725 would be the answer on the 5,000.
Okay, thank you for that. So it might just be, sometimes it might just be better to let the child keep carrying it forward. Maybe they get better from it, but I guess it all depends on the situation. Okay,
That's right.
that's the last question I have in the chat. Does anybody want to ask, unmute and ask a question? There is option for that too. Okay, over to you, Rev.
I would like to add one more thing. So for the previous question I answered, the person asked, is there such thing as overinvestment? Would it be wise to invest in all Magnificent Seven companies? So for someone who's looking to invest in all Magnificent Seven, a simple strategy you can use to, I guess, build your portfolio if you're just starting out is to look for a fund that gives you high returns. So such as the US equity, that could be your fund to build wealth essentially. Then you could look into a dividend fund. So a fund that will pay you out dividends consistently. A good one I've looked at is called HDIF, HDIF. It gives you out dividends. There are also many dividend funds you could look into. So that's a dividend fund you could use. And then you could have an income fund. So that fund is there for protection, is something that gives you consistent returns year after year. These funds could give you 5%, 3%, 4% return every single year. That's something you could look into. And then if you're not someone that likes the US, because I know some people when you say US equities, they're like, they don't want to invest in the US because of Trump and all these things. You could look into Canadian equities and you could put your money in there, and that's also pretty, gives you good return and it's pretty safe as well. So that's something you could look into to start building your portfolio if you're just starting out. So.
Okay, just a quick question for Kamsi. You did say that when you take RRSP, you decide where it's going to be invested, but my experience was different. I took RRSP in a bank and they never told me really where they're going to put that money. And now that I know this, it makes me uncomfortable. Is there a way to transfer RRSP from one organization to the other?
Yeah, so if you have your money in a bank, even you could do this for RSP, TFSA, even First Home Savings Account, RESP as well. You could transfer your money from one financial institution to another. So for example, if your money's in the bank, in the RSP from the bank, you can transfer your money from there to maybe a Fidelity or even like a IA, Sun Life, something like that. You just have, there's a couple forms you have to fill out and the advisor will help you take care of that. And after, I think it takes about 30 days to complete the transfer. It can be quicker depending on the complications of the transfer. But if you go through the advisor, it will just be transferred over to a new account in a different institution.
So basically, I can come to you and say, I want you to transfer my RSP from CIBC, for instance, to somewhere I will know where this money is being put in and know how to increase my benefits. Okay.
Yeah.
Thank you for that. Okay. Any other question? You did talk about life policy as foundation to prepare ourselves for a proper financial foundation. Can you throw more light on the type of policy that we may consider that can give us opportunity to grow our fund as well as provide for our descendants?
Okay, so there are many, so the main funds that, or the main the main insurance policies that will help you build money in the insurance policy is a universal life policy or a participating life policy, also known as whole life policy. So these policies have a cash value. And one thing to be aware of is that the cash value is not like a savings account. It's money there that you can borrow against for anything that you want to do in the future. Maybe you want to have a project or you need some money quickly, you can borrow against it to use for that project, but you have to also pay back that money. So it builds a cash value that you can use throughout your whole life. So that's kind of like a living expense or living access to capital you have. And then the death benefit also grows as the policy is in place. For example, for a participating life policy, if you put your money into that policy, you have the cash value and you have the death benefit. The cash value grows over the years and also the death benefit grows over the years. So let's say you're 30 years old, you bought a participating life policy and you died or you passed away, unfortunately, at age 80. Your death benefit would have grown depending on the return in the insurance policy. For example, if you bought a $200,000 insurance policy, so the death benefit was $200,000, and you died at age 80, that $200,000 face value death benefit would have increased by the time you were 80 years old. So you're not just going to have $200,000. That money will also increase as the policy is in place. But the good thing about it is that $200,000 is guaranteed. So no matter what happens in the market, no matter what happens as you have the policy, you are guaranteed to receive $200,000, or your family guaranteed to receive $200,000 when you unfortunately pass away. But if you put the money in there, it's going to grow anyway. And also, your cash value is also guaranteed. So you have a guaranteed amount of cash value that you can receive in the policy. So even if the market doesn't perform well, you are guaranteed a certain amount of cash value as the years go on. So depending on what the company or depending on what the insurance company decides to put the return as, is a guaranteed return you can see in your insurance policy. So usually you can get like a 3% return. So every year you get a 3% return on your cash value so that your cash value can continue to grow. So these are some things you could look at in the life insurance policy. You could also even utilize a critical illness policy. For example, there's some critical illness policies that have return of premium at death. So basically, if you have a critical illness policy, you're paying a premium for that policy every year or every month or annually, depending on how you want to pay for the policy. So if you were to pass away suddenly and you never use your critical illness policy, your family can receive all the premiums you paid for that policy. So essentially, the policy, you got it for free because all your premiums are paid back to your family. So that's something you could also utilize for critical illness. And a similar thing occurs with a disability policy as well. If you have a disability policy, you can get about 50%. So it won't be 100% as with the critical illness, it'll be 50% return on premiums if you were to pass away. So your family will receive 50% of the premiums you paid on the disability insurance. And also mortgage insurance is another one that people can utilize. If you have a mortgage of 300,000, you can get insurance on it so that if you were to pass away, unfortunately, your money would be returned to the coverage you have on your mortgage would be returned to your family so that they can pay the mortgage because you passed away. So these are some things that you can utilize, and these are things that could actually help you build your financial foundation and protect you from emergencies and unfortunate events happening in your life. So
thank you. I know Joshua have another appointment, I'm told by 1, so I'm going to round this up now. If you have any more questions, you can contact them individually. I don't know if their contact was put on the chat, but please feel free to put your contact on the chat so that anyone who wants to speak more can reach you and or need your help with anything. They can reach you, and that way they can benefit from your wealth of experience. Thanks to all of you for coming, and I want to seize this opportunity to say, please stand by for more informative training that we may organize in future. We want to make sure that we do things right and we operate with knowledge that delivers. Pastor Shade, I would like you to have the last word.
Thank you everyone for joining today. Our sessions are meant to be very informative, and this is very informative. Like I said, I've been in Canada like 30 years. There are so many things that I thought I knew that I didn't know. So once there are more seminars, please share with other people. Somebody will always benefit from something. But anyways, we had this live streamed on YouTube, so I will share the YouTube link. You can forward that to other people so they can still learn. The goal is for us to continue to give knowledge and transfer knowledge and make everybody gain what they can gain, because you never know. So I will share the YouTube link with all the people that have been here today. Please go and rewatch it. You will learn something. There are so many things that I wish I knew when I just came to this country. I think using those tax software, we don't really learn much from that. We think that we're saving money, but all this information session knows that sometimes we really need the specialist in each of these areas to put us through the right way and help us in great ways, so that we're not in, like Reverend said, Did he say give them back their money or something, or tell them I'm not earning again or something like that?
Oh, yeah. If you're going to be paying 33% because they added 2,000 to your salary, why do you need that? You can as well say, please don't increase my wages.
Yeah.
But now we
Yes.
have the solution is to put it in things like RRSP and reduce yourself back to the lower bracket, which is fantastic.
Yeah. Okay. So thank you, everyone. Thank you, Joshua, for joining us today. Thank you, Kamsi, for joining us today. And thank you, Reverend Chooks, for hosting this program today.
Thank you. And God bless you, all of you. Thank you for coming. God bless.